Now, Don Galante, Senior Vice President of Fixed Income at MF Global, he says the big question now is when will the Fed take the foot off the pedal? That's really question everyone wants answered. I'm not sure that the minutes today gave us any more insight into that, even though there does seem to be a little dissension in the ranks there.
Yeah, no, actually, if anything, what they've done is they've given us a stronger handle to equilibrium. I think what they're telling us is that there is indecision, and that's probably a good thing, because that tells you that some people believe the economy is coming back. Some people believe it's coming back without an inflationary story. And at the same time, there are concerns with regard to the housing market and where we are. So, you know, I think the market all during this year has been looking for equilibrium. I think that's where we are right now. So 381 is probably a good yield. We're into a range trade going forward.
Well, you say about some people looking at the market coming back, or at least the economy coming back. Is the economy coming back without job growth?
That's a big question, and that's an interesting question in the next 6 months. I think we need to see they answered. You know, clearly jobs have gotten better. Growth has gotten better. It's not positive yet, and it's going to continue to take time because that is a lagging indicator. And we still have damage. You know, this was a recession that was led by real estate, and it takes time to work through these things.
Now, the Fed has said that it's going to watch the impact of the dollar on inflation. The theory having been, at least until now, that with the economy not growing that much, that inflation's not going to get out of hand, even though the dollar still keeps going down. Do you think that's going to change anytime soon? And then what's going to happen with the Fed in reaction to that?
No, I don't think it's going to change. I think they're going to continue to monitor the dollar. They're going to continue to monitor inflation. Inflation is the key. You know, clearly the majority of commodity prices on a global basis are done in dollars, and that's a consideration.
Don, let me tell you about something Bill Gross, he was on this morning on TV and on radio of PIMCO. He said asset markets in the U.S. and the U.K. may suffer as governments withdraw stimulus measures. We're going to play a soundbite of Mr. Gross, and then we'll have you react to it.
What we're focusing on at the moment is the end of quantitative easing. That's one thing that we're relatively positive on, and what the Fed has announced in their past meeting. And so by the end of March, we're going to see the absence of $1.5 trillion worth of check writing. What does that mean? To us, that means 30 basis points higher in terms of yields.
And Mr. Gross also saying that the markets will have to readjust to the absence of what he called their sugar daddy.
Well, at the same time, a few FOMC members saying today that more stimulus might become desirable. So which is it?
The bottom line is, after trading for 29 years, anytime somebody steps out of the market that's put $1.2 trillion in, you know it's going to affect the market, and you have to price for it. I think the key to what Mr. Gross was saying, though, has the market already priced for that? We've already seen 10-year yields climb 60 basis points since the beginning of December. So maybe we've already taken that into consideration. And the notes we saw out of the Fed today, you know, they're still concerned, as they should be.
Well, so do you disagree with Gross then, that you know, he doesn't think Treasuries are as good a place to put your money right now?
You know what? I believe in diversified portfolios. Yeah, maybe in the short end I agree with him. I think in the long end they're going to trail back a little further. I do agree with that. I wouldn't be surprised to see 4%, but at 4% I think they're a buy.
Well, we see that yield difference between 2- and 10-year notes reaching the widest in a week.
A week in history, right? I mean, you look at where the 2-year, 10-year curve is and the steepness of the curve. That dictates where the economy is and what people really believe. When you start to see what we call a bear flattener in the curve, where 2-year yields start to rise aggressively because people anticipate the Fed raising rates, that's when the economy really is turning around.
Well, here's the question, too, just quickly. When everyone expects this to happen, how do you make money?
Strategies, duration strategies. You know, in a bear market where rates are going to rise in this kind of environment, you go into barbell strategies. You're in cash and you're along the long end, because the middle is where the pain is going to be, because that's where rising rates will affect. Or you know, you look at where the credit products are as well. Those are considerations.
Don Galante, Senior Vice President of Fixed Income at MF Global, joining us on set today. Thanks for coming, and Happy New Year.
Happy New Year.